Now, I will present three notable Malaysian companies: Farmaniaga, BAT Malaysia, and Aeon Credit Service. Farmaniaga. Farmaniaga, established in 1994, is a leading pharmaceutical group in Malaysia. They handle everything from research to marketing. In 2021, they became the first Malaysian company to manufacture a human vaccine, showcasing their dedication to public health. Next, BAT Malaysia. BAT Malaysia, with a 51.7% market share, has been a major player since 1912. They offer high quality tobacco products and have expanded into reduced risk alternative. They balance consumer preference with health consideration by investing in less harmful products. And lastly, Ion Credit Service. Found, Founded in 1996, Ion Credit Service offers credit cards, personal loans, and insurance products. Their customer first philosophy ensures flexible payment plans and personalized consultation. They also launched Malaysia's first digital Islamic bank for convenient banking experience.
Now, let us look at the trends of these three companies based on their statement of financial position from the past 3 years, from 2021 to 2023. First, this is Aeon Credit's financial position. Aeon Credit's total assets have shown a steady increase over the past 3 years, indicating growth and expansion. This increase is primarily driven by the rise in both non-current and current assets. Next, the growth in non-current assets, including plant and equipment, right-of-use assets, and investment, reflects Aeon Credit's long-term investment strategy to enhance their operational capacity and future revenue. Third, the increase in current assets, such as trade receivables and cash balances, suggests improved short-term liquidity and better cash flow, ensuring that the company can meet their immediate obligation. The total liabilities also have fluctuated but increased in overall. A major component is borrowings, indicating a reliance on external funding for operations and expansion. There is also increase in current liabilities, including trade payables and other payables, which suggests higher operational expenses and obligations that need to be managed in the short term. Non-current liabilities, primarily long-term borrowings, have remained relatively stable, indicating a consistent level of long-term debt used to finance the company's growth and investments. Some key takeaways from this financial position is asset management. Aeon Credit has shown strong asset growth, with both non-current and current assets increasing, which reflects its strategic investments and improved liquidity. Secondly is equity strength. The rise in total equity and retained earnings points to Aeon Credit's profitability and prudent earnings retention, which can enhance their ability to reinvest and grow. Third is liability considerations. While the company has managed its non-current liabilities well, the increase in current liabilities highlights the need for effective short-term financial management to ensure their liquidity and operational stability. Overall, the financial health of Aeon Credit is consistent with the increase in assets and equity, coupled with manageable liabilities, that can show Aeon Credit's solid financial position and growth potential. Next company is British American Tobacco Malaysia's Berhad financial position. BAT Malaysia Berhad's total assets have consistently decreased over the past 3 years. This decline reflects strategic adjustments in asset management, potentially aimed at optimizing their resource allocation and improving operational efficiency. Despite the overall reduction in total assets, there has been a slight increase in property, plant and equipment, indicating ongoing investments in maintaining and enhancing physical assets to support their business operations. The constant level of goodwill over the years shows stability in the company's intangible assets, with no impairments or additional goodwill, reflecting consistent performance in acquired businesses. The reduction in deferred tax assets suggests changes in a deferred tax calculation or realizations, possibly due to adjustments in the company's taxable income or tax planning strategies. The slight decline in equity attributable to owners over the years indicates a stable yet slightly diminishing equity base, potentially due to lower profits or higher dividend. Uh, the overall reduction in total liabilities, including significant decreases in borrowings and payables, suggests effective debt repayment and reduced reliance on short-term financing, enhancing their financial stability. And some key takeaways from the company's financial position is their asset management. BAT Malaysia Berhad has experienced a significant reduction in total assets over the past 3 years, with notable declines in inventories and receivables. Despite this, investments in property, plant, and equipment have continued, indicating a focus on maintaining physical assets. Equity and earnings, the company's equity and retained earnings have remained relatively stable, with minor decreases reflecting strategic profit retention and dividend policies. And the stability of goodwill suggests no impairments or acquisitions, indicating consistent business performance. Next is liability management. The reduction in total liabilities, particularly in borrowings and payables, demonstrates effective debt management and a focus on reducing financial obligations. The increase in lease liabilities, however, indicates long-term strategic commitments to operational assets. Lastly is BAT's financial health. Overall, BAT Malaysia Berhad shows efforts towards better cash management, evidenced by increased cash balances and reduced liabilities. These actions reflect the company's strategic adjustments to enhance liquidity and financial stability despite the declining asset base. And the third company is Pharma Niaga. Pharma Niaga's total assets have shown a trend over the past 3 years. The slight increase from 2022 to 2023 suggests efforts towards recovery and stabilization after a significant drop from 2021 to 2022. The accumulated losses have increased significantly, indicating ongoing financial challenges. This highlights the need for the company to focus on profitability and cost management to improve their retained earnings. The increase in non-current liabilities, particularly in borrowings and lease liabilities, reflects the company's strategy to secure long-term financing for its operations and growth projects. The fluctuations in borrowings indicate changes in the company's financing strategy, with a notable decrease in short-term borrowings from 2021 to 2023, reflecting efforts to reduce reliance on short-term debt. Some key takeaways for Pharma Niaga's financial position is their asset management. Pharma Niaga's total assets have shown fluctuations, with a recovery observed from 2022 to 2023. An investment in non-current assets highlight Pharma Niaga's focus on long-term growth. Next is liquidity and equity. While current assets and liabilities indicate strong liquidity, the increase in accumulated losses underscores the need for improving profitability and earnings retention. Financing and liabilities, the strategic increase in share capital and non-current borrowings points to efforts in securing long-term financing. However, managing high current liabilities remains crucial for their financial stability. Lastly is Pharma Niaga's operational efficiency. The rise in trade payables and borrowing suggests higher operational costs, necessitating effective cost management and improved cash flow practices.
So next we move to financial ratios and its interpretation. So here we have three companies, Aeon Credit, Bet Malaysia, and Famaniaga. So for the first ratio, we have liquidity ratio. A liquidity a liquidity ratio measures a business ability to use short-term asset to pay off short-term commitments. This ratio is crucial for understanding a company's operational effectiveness and financial stability. A ratio of 1 or above is generally considered appropriate, indicating a good liquidity. So for the formula, we have current ratio equal to current asset divided to current liabilities. So let's start with Aeon Credit. This company exhibits cyclical short-term financial health. In 2022, we saw a notable increase in liquidity, but this was followed by a decline in 2023. Next, we have BAT Malaysia. The current ratio for BAT Malaysia has continuously been below 1. This indicates possible challenge with liquidity and short-term liability coverage. Lastly, Famaniaga experienced a significant drop in liquidity from 2021 to 2023. This declining trend suggests that the company is facing serious liquidity issues. So, for the conclusion, and credit variability in liquidity strength may pose risk if not addressed, but Malaysia needs to improve its short-term financial management to resolve its ongoing liquidity issues, and Famaniaga must urgently focus on improving its liquidity management to avoid further declining. So second ratio is solvency ratio. So solvency ratio are financial metrics that measure a company's ability to meet its long-term debt obligation and ensure long-term financial stability. One common solvency ratio is the debt to equity ratio, which calculates the percentage of debt to equity held by shareholders in a corporation. So for the formula, we have debt ratio and equity ratio equal to total liability plus total equity equal to total liabilities and equity. So let's start with Aeon. The company is showing improved financial leverage and steady solvency with a progressive decline in its debt ratio every year. So next, Bet Malaysia have demonstrated progress in lowering its debt ratio over time, similar to Aeon. And next, on the other hand, Famaniaga has faced considerable solvency problems with negative equity in both 2022 and 2023. So in conclusion, Credit and Bet Malaysia are on path to improve solvency, showing showing better financial leverage and stability. In contrast, Famaniaga is facing significant solvency issues, indicating a high risk of unstable finance and potential insolvency without corrective measure. So next, we move to profitability ratios. So profitability ratio financial metrics used to assess how profitable a firm is in relation to its revenue, assets, equity, and other financial variables. One crucial profitability ratio is the net profit margin, which calculates the percentage of profit generated from every ringgit of sales. So for the formula, we have net profit margin equal to net profit divided to net sales. Let's start with Aeon Credit. The company has shown good profitability, evidenced by notable growth in its net profit margin in 2022 and 2023. Next, Bet Malaysia has experienced a steady decline in profitability over time, as indicated by decreasing profit margins. Moving on to Famanaga, to company experience, the company experienced losses in 2022 and 2023, resulting in negative profit margins and subpar profitability results. So in conclusion, AIM Credit have strong and increasing profitability highlights efficient management and operation, but Malaysia declining profitability suggests a need for strategic change to improve margins, and Famaniaga's serious profitability issues indicate that urgent action is required to reverse the negative trend and restore financial stability. Next ratio is efficiency ratio. Efficiency ratio are financial measurement that assess how successfully a business uses its resources to produce income and optimize profits. The main function of efficiency ratios is to measure how well a business uses its resources to achieve its goal. So for the formula, we have total assets turnover equal to net sales divided average total assets. So let's start with Ion Credit. The company has low assets turnover ratios, indicating that it uses its asset less effectively to produce sales. The difference between 2021 and 2023 is minimal, suggesting that there has been little improvement in this area. So next, Bank Malaysia has high asset turnover percentage, although these have been gradually declining over time. So on the other hand, Famaniaga has seen an improvement in the efficiency of employing its asset to generate sales, as indicated by declining asset turnover ratio over time. In conclusion, AM Credit needs to improve its asset utilization to increase efficiency. Bank Malaysia, while currently efficient, must address its slight decline to maintain its performance. So for Maniaga's significant increase in efficiency is encouraging and suggests effective asset management to practice that could be applied to address its other financial challenges.
So for the last financial ratios is market value ratio. So market value ratio are tools that investors use to determine how the market values a company stock. So one of the ratio is market capitalization. It displays a company's overall market value based on its outstanding shares. This ratio help investors evaluate stock prices and compare them across sector of businesses. So for the formula, we have market capitalization equals to share price times number of shares outstanding. So AM Credit shows a consistent increase in market value ratios from 2021 to 2023. This continuous rise reflects a possible increase in market confidence and valuation of the company. So Bet Malaysia's market value ratio have decreased from 2021 to 2023. The depreciation in 2022 continued into 2023, indicating possible factors affecting its financial performance or investors' sentiment during this period. So Nets Famaniaga exhibit a decreasing trend in market value ratio every year from 2021 to 2023. This decline is attributed to a falling share price despite a slight increase in the number of shares outstanding. So for the conclusion, AM credit continuously increased in market value, reflecting growing market confidence and valuation. But Malaysia was decreased in market value ratio, possibly due to factors affecting financial performance or investor sentiment. And for Famaniaga, declining market capitalization due to falling share prices, highlighting the need to restore investor confidence and improve market valuations. That's all.
Next, we will be moving on to comparative analysis. Firstly, the vertical analysis. It was a technique used to display the proportional size of each account to the overall amount. Every line item on a financial statement is expressed as a proportion of the total through vertical analysis. The formula is using percentage change by using our current year minus previous year divided by the previous year and multiplied by 100. And then we have horizontal analysis. Here, it used to assess a company's performance over an extended period. Corporation can better identify the direction and magnitude of account balance changes by comparing financial results from previous periods with more recent financial outcomes. The formula is common size percent analysis amount divided by best amount and multiplied by 100. Here is the income statement showing trend analysis for Ion Credit Service. And here is an income statement for BAT Malaysia showing trend analysis. And here the income statement of Pharma Niaga showing their trend analysis.
Next, the conclusion. Based on the comprehensive analysis of the financial statements and ratios of Aeon Credit, VAT Malaysia, and Pharma Niaga, we can conclude that throughout their financial performance, that is for Aeon Credit, it displays robust profitability and liquidity, supported by efficient credit management and a strong market position in consumer finance. As a result, it made it an attractive investment option with the potential for continued growth in the consumer finance sector. Next, VAT Malaysia show moderate profitability and liquidity despite facing challenge in the tobacco industry and was able to maintain a satisfactory market and prudent debt management practice. Finally, the Pharmaniaga company is able to regulate the change of the medical and pharmaceutical industry while maintaining an ever-sufficient market, despite facing profitability and liquidity challenge affected by inherent competitive pressure.